everybody. Welcome to the Financial Tangent Podcast. My name is Ben, and we have Chloe and Rich with us. And we are super excited to be here today. We are going to be talking about retirement accounts, specifically IRAs and 401ks.
Absolutely. So we jumping right into it?
I think so.
Oh, excellent.
Yeah, we'll jump right in. I think kind of the first thing we were going to touch on was kind of all things about these accounts and what they mean for you as you get started working, and kind of what to look for, what to look out for, what to keep in mind, because there's a lot of incentive to use these vehicles for retirement, and also things to just kind of keep in mind, as we, talk about these to um, make the most of retiring and trying to, make the most of your finances.
Perfect.
Absolutely. Well, I'll go ahead and jump right into the Roth IRA.
Yeah.
And I think we're kind of gearing this podcast towards somebody that is new to retirement investing and stuff. So we're just going to cover the basics here. So let's jump right into a Roth IRA, which is a type of individual retirement account where you can contribute with after-tax dollars towards your retirement savings. And that's key. It's after-tax dollars. The tax advantages are the contributions and earnings in the Roth IRA are tax-free. So you invest with that money with after-tax dollars, it grows tax-free. And when you pull it out at retirement time, you pull it out and you don't have to pay taxes on that.
Yeah. So this is money that's already been through your company's payroll. You will not, incur any additional taxes on it. So it's a great way to, know that this is what I have for retirement.
Yeah, and you don't have to worry about
Yeah.
like 30% tax when you take it out. It's just already covered.
Absolutely.
It's a good option for if you don't know what tax rates are going to be like when you retire, maybe you're expecting they'll be higher than they are currently. That would be a good option to go for is the Roth IRA.
Yeah, absolutely. So Rich, as I get started, what can I contribute? Because I'm kind of in the building kind of years of my life. What can I contribute? Is there a maximum that I can contribute to, or what are some of the rules, I guess?
What are the rules? Well, I'm
Yeah.
guessing you guys are under 50, right? So the way the tax laws are now, if you're under 50, you can invest $7,000 towards your Roth IRA each year.
Okay.
So, and if you're over 50, like me, you can invest $8,000.
So there's an extra $1,000 that you can use as almost like a catch up kind of opportunity if you want.
Absolutely. However, there's a caveat. You'll start to lose some of your eligibility to invest in a Roth IRA as your income creeps up. So
Yeah.
right now for individual filers, it's $146,000. You start to lose eligibility, and around $230,000 for married filers.
So what does that mean? You lose eligibility? Like you can't invest as much?
Exactly,
Okay,
absolutely. And there's a table, and check it out online. If your income is creeping up into that bracket, there's tables online that you can.
Interesting. Okay.
Yeah, absolutely. So
nice. So based on your when you get past either of those thresholds, 146 or 230, then it becomes a little bit different with each kind of maybe bracket. Are they bracketed, if you will?
Yeah, there's a
Okay.
table that.
Okay.
Absolutely.
Nice.
So yeah.
Nice. Nice.
We didn't want to necessarily get into that because people in that income level are going to be a little bit more financial savvy than I think our target.
Or, at that point in their career, they've already kind of gotten started in their retirement investing. So, we're all getting started, or Chloe and I are getting started. Rich obviously is very well seasoned in this aspect. So, we're going to look to Rich to understand all the rules and everything like that, because, it's important that as you get started, that you don't maybe, break the rules or go beyond them, because then, all of a sudden you'll have,
penalties or
penalties and IRS
yeah,
and whatnot
all the
involved.
good
So
fun stuff.
we hope that this is useful information to you, thinking about that. So there's a Roth IRA, but then there's another type of retirement account, which we'll get into next. And I think it's kind of a great kind of segue into the second and third subjects that we'll talk about, but it's a traditional IRA. And it's kind of related to a 401k, which we'll get into later. But Chloe, tell us a little bit about what a traditional IRA is and what that
Sure.
means for savers.
So from my understanding, the traditional IRA predates the Roth IRA. So this is a little older, I think, of a concept. And basically that's I guess after tax dollars, but then
Yes.
it grows tax free, but you have to pay taxes on it when you take it out.
At retirement,
That's
absolutely.
what my understanding is.
Yep.
And then there's something that you can like claim your IRA is like tax deductible. I'm not sure I totally understand that portion of it.
Sure. Oh, absolutely. So what happens is that when you contribute to an IRA, you're basically taking money out of your checking account, right? And you invest in your IRA, and then at the end of the year, when you do your taxes, um, since it's considered before tax money, it's actually tax deductible.
Oh, okay. So you don't pay taxes on it when you put it in. It's, I see, because then you have to pay taxes on
They
it.
basically are excluding that from your taxes.
Got it.
Okay.
So yeah, absolutely.
Now, because I'm thinking about that, so if I wanted to do the traditional IRA, could I use the the funds to grow my money? It's you could grow your money with more purchasing power, right? Because you didn't spend on taxes, so you can maybe grow the money quicker. But then, yeah, when you take it out over time, the tax structure will change, maybe go up, maybe go
Yeah.
down, depending. So, arguably, could one argue that is that a better vehicle for retirement, investment vehicle for retirement, because you can have more purchasing power because you didn't spend the money on the taxes?
That's a really good point, Ben. The theory is that for the regular IRA, you'll have more money to invest because you haven't paid taxes on it. So that more money will grow more, but you're paying taxes on the back end.
Later.
Absolutely. And I think a lot of that just depends on whether or not you predict you'll be in a higher tax bracket when you retire, or if you're going to be in a lower tax bracket.
Yeah. It's a good thing to understand.
Yeah, absolutely.
Yeah. So what are the limits on a traditional IRA? Are they the same as a Roth IRA, or are they different? Um, or are there no limit? I mean, because I think a lot of opportunities for especially like Chloe and I, as we've gotten started, is we have 401k, and so then we're contributing to our 401k, but then maybe you would contribute to a traditional IRA, you know, when you maybe roll your 401k into an IRA, which is something that we can talk about more later. But what limits do I have on a traditional IRA, as I think about that as an option?
Well, there's no income limit. However, the 7,000, 8,000 rule applies.
Okay.
So
So it's the
absolutely.
same threshold, just the tax structure is different. So your tax structure for your Roth versus your traditional is going to be different. So
Absolutely.
that's kind of the
Right.
key difference there. Okay.
Yeah, definitely.
So Roth, um, pre-tax or post-tax, I'm sorry, traditional pre-tax. So
Absolutely.
All right. So then there's another type of retirement saving plan where this is the 401k, which is basically something that your employer will offer. And I know Ben had a good list started there. If you want to elaborate a little bit more on that.
for sure. So I did a little bit of research on 401ks, just kind of as, a young professional, just kind of getting started learning about, um, what that looks like. And you can do a traditional 401k, or there's also a Roth 401k, which you could probably, from what we just discussed, the Roth is going to be after tax, and then the traditional is going to be pre-tax. So the idea of the Roth 401k is relatively new. Not many companies do it compared to the traditional. You'll find traditional is more abundant, and then your Roth, is very close. A lot of companies offer both, but
I think
not
it's
all.
becoming more popular.
Yeah, it's kind of growing in a way, because the first company I worked had traditional only while I got started there. But then within the first year of me working there, they changed their 401k provider, and then it offered a Roth 401k as well, which was a totally new concept as well. So it's basically an account that makes withdrawals from your paycheck from your employer. The money goes in either pre-tax or post-tax, depending on whether or not you do Roth or traditional 401k. And the other thing to keep in mind is your employer match. So as you look at companies to work for, they might say, hey, we'll match up to 6%. That's a popular number that companies match. And that's free money that, your employer budgeted for with your position, right? So by making sure that you contribute to your account at least to the same percentage that the company will match you, that's free money on the table. So you might be offered, X salary, here's what we're going to pay you. And that can be very easy to focus on. However, something else to keep in mind is there's also a budgeted number on top of that in the 401k that they budgeted if they match. You have to be careful. And my understanding is, and correct me if I'm wrong, guys, some companies you have to work for a certain amount of time
I
before.
was just gonna say that there's a vesting
Yeah,
schedule that
yeah.
some companies will have. So sometimes it'll be like you have to work 5 to 6 years before you get 100% of what they've added to your retirement.
You always get your money back if you leave before.
Yeah.
Right.
So any
Right.
money that like I make or Chloe makes or Rich makes that we put into our 401ks will for sure be ours, regardless of whether or not we still work at that company or not. But something to keep in mind is that vesting schedule, because sometimes it might be like Chloe said, 5 to 6 years, or it could be, 2 or 1.
It depends.
Yeah, it's kind of like I feel like it's kind of the Wild West almost
Yeah.
a little bit.
Well, and Dad, you worked at one company where they had no vesting schedule. It was just you got 100% of whatever they put in day one. Which
Absolutely.
that's pretty nice.
Yeah,
But most
definitely.
places have a vesting schedule. So
And I don't know how they will present that information to you, or if they will put that money into your account after like you're fully vested based on the date. That's certainly, I feel like maybe this is something that's more advanced kind of as we get started, but keep it in mind because as you accept your role and move into the new job and get settled, you might start expecting or wanting to see the company match, and you might see it or you might not see it. So it really can depend on your company.
yeah. It's just
So
incentive to keep you there longer.
exactly. And so kind of right, like me asking about all these contribution limits, I looked up, what the limit was on the 401k because savings important, right? And so especially as you get started, if you save a lot early, you can produce returns off of those savings throughout your whole life. And so the new contribution limit for 2024 is $23,000 in your 401k account. So if you are under 50, that's your limit, and catch-up contributions are an additional $7,000 for a total of $30,000 per year if you're over the age of 50. So those are from the U.S. IRS. You can always quick Google those numbers; they'll pop right up.
Yeah.
And
I think they
yeah,
change year to year too, so something to just be conscious of.
not everybody maxes out their 401k, but a lot of people do. It's a super easy way to just get your money in the market. If you are interested in going that way.
Mhm.
I know previously in the podcast we've talked about like doing, Charles Schwab, Fidelity, other self, directed platforms. It's a great way to just get started super easily in the market too with your 401k.
Yeah, something I like about it is it's just an automatic thing that's taken out of your paycheck. So you can set what percentage you want taken out, and every pay period, it'll just automatically be invested into the funds that you pick. So I think that's pretty nice for people who honestly just take an hour when you get it set up and then just kind of forget about it. I don't know if you want to look at it like once a month, or I've been told once, twice a year, or something like that. But
Once a quarter, maybe.
yeah, but it's nice if you don't want to fuss with that part of investing all the time.
Mhm. So Rich, what is it when I look at um, like my options to invest in my 401k. You'll typically see a list from your provider of either targeted funds, kind of like what Chloe was talking about just now, or like bonds, or you can do like indexed funds. So what are kind of some of the ins and outs of those, and what would those look like? Because sometimes I've seen where in the two jobs I've had and the three different 401k providers that I've worked with, I've seen like the words aggressive and then balanced
Mhm.
or less aggressive. I've seen all that used,
Yeah.
but I might not know what that means and what does that look like?
Sure, absolutely. Well, after reading Jordan Belfort's book, and I'm a big fan of the S&P 500
Yeah.
fund,
Yeah.
and that's your 500 top companies in the market.
Hmm.
That's a nice index. It's got a proven track record for
And so we were
everybody.
just talking about that in our last episode, and it's more of the aggressive type, right?
Yeah, I would say it's bigger, so it's not as aggressive as like a fund that invests in smaller companies.
Okay.
So I don't know if they classify it as aggressive growth, but it's more of a growth, but it's you're fully invested in the stock market. But these are proven 500 companies, so it gives you
Nice.
a nice good return. So definitely. But if
Nice.
you wanted to be
Uh,
more aggressive, you're younger, you want more, you can go with like more of a smaller an index that invests in smaller companies.
I thought
Absolutely.
I could be wrong on this, but I thought more aggressive meant like more of your money was in the stock market versus bonds.
Sure.
So like a balance would be maybe a mix. More aggressive would be higher percentage in like index funds, and
Sure.
then less aggressive would be maybe as you get closer to retirement, that would be focusing more on the bonds.
Sure. Absolutely. But you could even
So,
go even more aggressive and go
okay,
with smaller companies. Usually smaller companies haven't been proven yet.
right.
So
So
they're,
it's riskier.
yes, absolutely.
Gotcha.
So,
Gotcha.
yeah,
And
definitely.
especially maybe as you get started, maybe something to think about too, yeah, is balancing your risk and your
Mhm.
reward. Um, but also you can change your 401k contribution percentage as well. So, as you watch, the S&P 500, on, your phone, online, you can change and I've learned through my companies, you can change your contribution percentage, and it's a very easy way to do that. A lot of it is done electronically now,
Mhm.
pretty much everywhere. So you can log in, make your change, watch what the chart is doing, and kind of just bring it to classic, kind of just, buy low, sell high. Maybe increase your contribution percentage when the market is down, and maybe back it off when the market's a little high. Um, I'm sure, will be technicalities of doing that, as I've experienced, where it might take a week or two, depending on your salary schedule, if you're salary or if you're hourly, and when payroll is processed, and when those funds will hit the market, and be invested. Some companies allow you to change it, whenever, or others might be once a month, once a quarter. I don't, have you guys run into that? Like, have you guys tried to change your 401ks and like run into any issues with like the schedule or like being able to change your contribution percentage?
No, I usually just do it maybe one, I look at it about once a quarter, but I probably make an adjustment once a year or so, so it hasn't
Yeah.
been an issue.
Yeah.
So,
And
I haven't had any issues. It might depend on like the pay period schedule, but if you change your contribution like right before the next pay period, it might take a couple weeks for it to cycle through.
yeah,
Um,
yeah.
but yeah, it's pretty easy. You can change the percentage of your contributions or change the amount of like money that you put in. I'm not explaining that well, but
Well, that's a
change.
great question because the contribution really is the amount of money coming out of your paycheck to go into the account. So, and forgive me, that's poor explanation on my part. But yeah, that's what your contribution is what you are putting into that account per payroll.
Yeah.
Yeah. Yeah. So kind of additional options that you might see in job postings are company stock or previously I think closer to the time that maybe Chloe's and my parents were getting started or maybe even like Rich's parents and our grandparents was like pensions. And I think that those are kind of previous investment vehicles that don't exist as much today.
Yeah, they're kind of dying,
Yeah,
fading out.
yeah. And company stock is also something too, but you'll see that more in either like a publicly traded company, or maybe like a family-owned company, that, is, large and offers company stock to their employees too. I mean,
Mhm.
have you guys run into that in any of your careers or job searching or anything? I have.
no, yeah,
I
absolutely.
know, well, Ford will do, I think they have like a stock you can invest like their Ford stock,
Okay. Did you get a
but
discount for Ford employees to purchase them?
I don't know about the discount. I'm not
Okay.
familiar with that, but yeah, some companies will do profit sharing that if they make a decent profit that year, they'll what's the word? Uh,
Like distribute, will they?
distribute that profit to the
Oh, in
employees.
terms of share
Yep, and that'll
stock.
go. I think it might depend on the company, but that will. I mean, for myself, that just goes right into my 401k,
Oh,
so I
makes
don't
sense.
have to worry about that.
Nice.
My only caveat on that is if you invest in a single company stock,
Right.
don't make it a large
Yeah.
portion, make it a small portion of your
Yeah.
portfolio.
Absolutely.
Yeah.
So,
Yeah, because you think about it, and what we were talking about last time is like an index fund, especially of like the S&P 500, is going to be well diversified versus if you have just one company stock, your eggs are kind of all in one basket.
Right, and then
Um,
like if it's really popular for, I'm trying to think of one that was really popular for a season, maybe Blockbuster, where it
yeah,
went like really high
yeah,
and then it went
very,
pretty low.
very low.
Like
Yeah.
it's just more volatile
GameStop or
and
something.
it's
Yeah.
like
What
it just
you saw.
depends on what's really popular, maybe crypto, I don't know. I'm not familiar
Sure.
with that, but
Yeah. So kind of our group kind of collective thought on this was, try to contribute, as much as you can to these accounts because they will help you in the long term. And you look at, the options and make sure that I think based on our discussion just now, we recommend staying as aggressive as you can while you're young. And also many investors still into their 50s are remaining very aggressive, or even 60s are remaining very aggressive in the market for the growth. So
Can
that's
you-
maybe an opportunity for like another discussion is like, how are those philosophies changing over time?
yeah. I was gonna say, can you elaborate more on why it's more important if you're younger to be more aggressive?
So the S&P 500's average return percentage, Rich, is around 10, I think, right? Consistently.
What did we say last? 11.7.
It was
right?
11. Yeah. So that is, traditionally what that will produce. And so that's pure stocks of, like Rich has said, the 500 largest companies. So you might, and it's all about, the nature of the business realm at the time, but you could buy one stock and it would go up 20%, right? But you also, know that based on the averages game that the S&P 500 will remain very, consistent over time. So doing stocks is more aggressive because it's, naturally, the companies want to produce a return for their shareholders. And when we do like maybe more balanced or risk averse, kind of less
Mhm.
risky with bonds, you might see a return on a bond around 5 or 6%. I mean, so we're recording this in April 2024. So maybe about a year ago, kind of with some of the monetary policy that's been going on by, the Fed and everything, we were seeing bonds that were paying as high as like 8-ish. It could be even higher.
Mhm.
Percent, which is for a bond that's a guaranteed return. That's a pretty attractive number, but it obviously isn't, as high as what we would see in the S&P
Mhm.
500 or perhaps an individual stock as well. But what are your guys' thoughts on everything that we've discussed as well? Because I know I just kind of shared mine. So
Um, well, I just wanted to throw in there too, when you're younger and investing more aggressive, let's say the stock market plummets, you have 30, 40 years to ride that out and watch it go up as well. So that's why it's important as well to invest more aggressively.
yeah, you have time. Yeah, time is on your side. So
Absolutely. No, I totally agree. I think the consensus too is that if you can, whether it's through your Roth 401k or just a regular outside of your employer, invest in a Roth.
Mhm.
It's just having that, not having to pay taxes on that money at retirement is just too good to pass up.
yeah,
So,
yeah, taxes
absolutely.
always go up,
Right.
traditionally. So you'll see them increase over time.
Right. And one thing we didn't mention yet was with a regular IRA and a 401k, when you turn 73, they have what's called the required minimum distribution.
Oh,
Mm.
And
okay.
there's a formula, and you're required to start taking that money out of your IRA.
So now we start to think about, yes, the time at which we are using these funds. So
Right,
when you're
absolutely.
73, if I'm hearing you correctly, you
Mhm.
have to take certain distributions, which is money coming out. So the contribution is going in, distribution is money leaving the
Right,
fund.
absolutely.
And so
And
that's calculated.
right, my dad will be able to explain the formula because he has to do it. So
I gotcha.
but anyway, what could happen though with a regular IRA, um, is it could grow to a point where that required minimum distribution is rather large,
Mm.
and which creeps you up at a very, higher tax bracket.
Yeah,
You don't have that with a Roth IRA or a
gotcha.
Roth 401k.
Gotcha.
I
So
actually didn't know that. That's good to
yeah,
know.
right,
Okay.
absolutely.
That
So
is
it's a
good.
good
So
distinction.
so the Roth features in a 401k or an IRA, you already pay the taxes on it, so then you don't have the required
Minimum
minimum
distribution,
distribution. So
RMD.
so that's also something to think about too, for the future. So you don't have maybe as much money growing, right? Because say for example, you get paid $5,000, for example, you pay taxes, maybe say like $500, for example. So instead of $5,500 that's invested in growing, you're only investing $5,000, now, but in 40 years, you
Mhm.
won't have to take a distribution on that money in the future.
Unless you want to.
Unless you want to. Okay. So that's interesting.
Yeah,
And
absolutely.
that's definitely something that is something to consider as you become more experienced with these types of retirement accounts too.
Absolutely.
I think Chloe is interested in sharing what the S&P 500 might look like across a few different financial institution systems. So they might have different names. What were you?
Yeah.
Because you had mentioned something about that as we were preparing for this, that there's different names
Yeah.
for some of these funds.
So when you go and opt into your 401k, there's a whole list of funds that you can pick from. And it might not say S&P 500 index. There might be a name 500 index. So like, for example, if your company does Vanguard, it would be Vanguard 500. And if you click to see more information on that stock, typically it will have a description that says like tries to follow the S&P 500 index or like a large capital, like say large cap index, which just means capitalization companies. So companies that I think I could be wrong on this, but I think large cap companies are those that profit like 10 billion or something or more. So
Oh, there's a threshold. Yeah, right,
yeah,
absolutely.
because yeah, and then mid capitalization would be 2 to 10 billion, and then small cap would be less than 2 billion or something.
Sure.
Maybe it's a million.
Smaller but more aggressive.
Yeah.
What would you guys think about, you know, are the biggest companies always going to produce the biggest returns? That's probably the whole area to review and discuss.
Yeah, that'd be a good episode.
Or would
right?
mid cap companies do that? Because
Yeah.
what I found looking in when I go to look at my 401k, I have a list of the funds that I can pick. And the information on those funds from the analysts at the companies, I found that I can click on the link to the fund, just like right on my computer, click it, and I can see what's called a Morningstar report. And that will show me the history of the fund, who manages the fund. We've kind of talked about that last episode a little bit as we were looking at different S&P 500 funds. So you can even do it for like small and medium cap fund mixes as well. It's a great way to just learn about the returns, what the outlook is on. They'll tell you if you put $10,000 in this account, this is our estimation of what it will grow into, in 20 or 15 years. I think you can set different, time frames to look at the growth.
Absolutely.
Yeah.
Yeah, very good.
What else do you guys think?
Did we want to talk about target date funds?
Yeah,
What that means?
we noticed that too, and I'm not as experienced with them. I think all of us are pretty, we're all pretty aggressive mentality when it comes to investing. Um, so what happens in a target index fund
So
for
basically,
retirement?
well, from what I understand, basically based upon how far out your retirement age is, um, you'll be invested in one of the funds and it'll automatically allocate a certain amount of your portfolio to bond funds. And the more closer you get to retirement, the more more money in bond funds it's going to invest in for
Gotcha.
you.
So maybe like over time it's going to go from being fully stocks to maybe like in your 40s it'll be maybe say 15% bonds and 85% stocks, and then when you're in your 50s and 60s it'll be closer to maybe 50% bonds, 50% stocks. So in other words, you will start changing, like the money will start that you're contributing as you contribute will start being spent on the bonds more over time versus the stocks over time. And I think that's the mentality behind that, because you're getting closer to retirement, so your guaranteed need for that money is becoming more and more. So you want maybe something that's less risky. Is that kind of the mentality behind that?
Absolutely.
Okay.
Yeah, because if you're more in bonds, it's a basic guarantee to get that money back. And the stock market's always going up and down. So it's just a less volatile, like your money's a little bit more stable that way.
Absolutely. I've never been a big fan of them just because I've always kind of felt that they invest in too much is invested in bonds on your behalf.
Gotcha.
And I've always wanted to invest more aggressively and get more money in stocks than what the fund recommends based upon.
Yeah.
And that would be your thought on these balanced bond
I feel
mix
like
funds.
though this would be a good option for those who investing might be confusing, and if you just want to pick something like a target date fund and just set it and forget it, that would be a good option because it's basically a managed portfolio and you don't have to do anything.
Yeah.
But I think from my understanding, the rate of your return is typically a little bit lower.
Gotcha.
But if you don't want to fuss with it, then I think that's a decent option.
Yeah, definitely. Definitely. So when thinking about getting started, you know, um, you know, I would probably take from our conversation, start big, do big companies that are going to produce a return, and maybe consider some of the medium and small cap, maybe depending on what time in the market, and what reporting what the reporting looks like.
Absolutely.
What do you guys think? Yeah.
Chloe?
Ben, I'm gonna disagree with you on something.
All righty, let's hear it. I like this.
I think you shouldn't look at the timing of the market. Just start investing. If it's high or if it's low, you know that your money is going to grow and come down, and that's part of investing. But over time, you should see it going up. But I wouldn't try to, I don't know, try to time the mid cap and small cap. Just start. I think that's the most important thing. So.
Yeah, well, and that's for sure hard to, it's like you put your money in and then you're like, okay, I'm ready for it to grow. And then it's like,
It
well,
might go
it's
down.
yeah, right.
So,
So it's
but you want to
thinking
over
about the
time,
long term. I
yeah.
I respect that, and
Mhm.
that's for sure. That's for sure something good to think about because I fall victim to the mindset of okay, it's in the market, I want it to go up now.
Yeah.
You know what I mean? I'm
But
not using the money for other stuff or whatever,
yeah.
and that's a psychology game.
And I want to put in there too, I feel like it's hard to time the market because there are so many variables based on, I don't know, pop culture, election year. I mean, it's just, I
Mhm.
would keep it simple and
Yeah,
just start today.
Yeah,
for sure,
regardless of interest rates and
Yeah.
everything.
Mhm.
for
That's a good
sure,
point.
for sure. So I think we usually do a little bit of a case study kind of thing. Chloe likes to do case studies. Do you have one for us today?
I do. This one's Feel Hopeless. So this is married, 36 male, wife is 31 female. We live in Queens, New York, and feel like we will never own a real house or have children because everything is so expensive. We are having major FOMO, fear of missing out, on home ownership because we are seeing family members scrape up and purchase homes with their higher incomes or family help. I make 175K, wife makes about 95K, and we have saved up 75K in cash, 80K in crypto. Oh my gosh, 350K in stocks in taxable brokerages. Also have 200K in 401K and Roth, which we can't touch. Only debt is 5,000 I owe in taxes. Wow. We still rent a 2-bed, 2-bath for $2,850 per month, and it's not the best, but it's about 1,500 square feet in Queens, and rent is stabilized. I feel like we will never own a home comfortably because they live in Queens, Long Island, and Westchester homes are incredibly overpriced. Um, and the monthly costs of owning home will far exceed our rent. We feel like we are falling behind our peers and don't think we can ever afford to have a child. And if we do, we will have to raise them in Queens as renters in a subpar school. I hate my job. Oh, there's so many layers to this.
Wow, yeah, this is getting juicy. Oh my goodness.
Field in general and feel as if for sure we'll have to take a pay cut as I will not be moving up in this field and will lose my current job. I'll have less earning capacity. This job insecurity definitely makes me feel like I can never afford anything more than what we pay in rent now. Wife and I, both low educated, unlicensed back office support staff. I'm an accountant with no master's or CPA. She is a paralegal. Okay.
What the bleep do
What
I
I
do?
do?
Do I move
Good
to
job.
Albany, Kansas, or Idaho? Um, you know, and this certainly is it does seem like there's a lot to digest in this situation here. For sure. It seems like they've done a wonderful job. I mean, I'll pick out some of the positives. It doesn't seem like
Yes.
they have a ton of debt, which is good.
Mhm.
You know what I mean? It sounds like they're hard workers. Um, you know,
I'm doing the math on here. They have between the cash, the crypto, and the stocks,
I was amazed. Yeah.
500,000.
I was
I think
amazed
you
with how
should be
much in
able to put a
crypto.
decent down payment on a home.
Around
You
here,
can
you could get your, so you could pay cash for a nice
Yeah.
home around here.
Yeah.
So
We
West
are,
Michigan.
yeah, West Michigan, for those listening who might not know.
I don't know how mobile their jobs are, but
Yeah.
if that's something they can do remote or whatever, come on over
Oh,
here.
Right.
Yeah,
Right.
move out west. I mean, they
Yeah.
mentioned that too. If they don't have a child yet, I feel like that's a lot easier to do without
Yeah.
having been stabilized in a school district or something.
Yeah.
It's
And
a
it doesn't
lot
seem
better.
like how do I explain it? It doesn't seem like maybe they want to be in Queens for the school anyway.
Right,
So
sure.
maybe, they can leverage the fact that they're debt free and find somewhere else with a good school for their kid.
Yeah.
And maybe their equation will change in their favor if they moved somewhere else.
Yeah.
A lot of people do that.
I don't know if he'll make $175,000 a year as an accountant over here, but
But what if you
still,
could, if you move someplace cheaper, they have about 500,000.
yeah,
Either put that down to
cash for a
pay for
house.
cash for a house, not have a house payment, or have a really decent down payment to make your monthly rate lower.
Absolutely.
And then do a job that you like.
Yeah, true.
You don't have housing to worry about if you pay full house for cash, but that's, I guess, I would look into that.
Yeah.
A different location.
Yeah. I'm amazed. I'm amazed with their interest in crypto. It seems like they've got a pretty good interest in crypto.
Yeah.
Which is something that we could for sure touch on in another episode. You know, I applaud the fact that they're debt free. I
absolutely.
applaud that. And I applaud that they're actually thinking about the quality of life, in the future, 15 years from now, as they're raising their kid through school too.
It's interesting to me. Sorry to cut you off.
That's fine.
Interesting to me that they have 500,000 saved up and yet they feel behind. That's interesting.
Mhm.
I feel like most people would not feel that way.
And who knows? They could maybe feel like that because it's like they talk about it with their friends or whatever, or they see what their friends are doing, or they research, for their area. A lot of it's just about, you know, um, focusing on yourself, right? Don't play the averages game. Don't look this way, look this way, Rich, what do you think?
Yeah, absolutely. Definitely. Don't follow FOMO.
Yeah. You could.
I think they've got a great
certainly,
start.
Yeah. I mean,
definitely.
Thinking about them, I mean, they're within within 11-ish years of how old I am right now. That it does seem like they're doing pretty well.
Yeah.
However, they certainly have some stuff to figure out too. I mean, it does seem like that they're pretty financially focused, so they're probably not happy in an apartment where they have to pay.
Yeah.
So that'd be my recommendation is like try to maybe if you're that financially savvy and you want to be somewhere where you can raise your kid in a good school, maybe try to purchase a place in a good school district where you can, either continue to do the nature of work that you do or pursue additional training and credentials to kind of bring your employment up towards that next level.
Yeah, that's a good idea that you brought up, like certifications. You don't necessarily have to get a master's degree, but I don't know what it takes to get a CPA. If that's with a master's or you just take an exam, I'm not sure.
Yeah, I think you sit for an exam, but
yeah, maybe that's an idea too. And then you're guaranteed maybe pay scales probably going to go up. So,
but then you think about the cost, right? The cost of that and the fact that they don't have debt, other than their taxes that they owe. What are your thoughts?
Yeah, definitely. So, with you guys.
That's an interesting one.
Yeah, that was a good one.
That's an interesting one.
Yeah,
for sure.
Really.
My comments would just be to them. So just remind yourself of what you've done well.
Yeah, they've done well for the only critique I have. It's just a high cost of living area.
Yeah.
Whether they want to stay there and hack it out, or they could easily go somewhere else, a lower cost of living, and
for sure.
And
we could talk about that sometime, like cost of living and salaries, and like where it all is, like us in Michigan versus maybe New York, somewhere. That'd be kind of cool to
absolutely
analyze. So, Well, thanks, guys. I
Yeah,
appreciate
that
it.
was fun.
Yeah.
Absolutely.
Yeah.
So yeah, it's nice to get in person to do a
Yeah.
episode once in a
All
while.
three on the same screen.
Right, definitely.
Love it. Love it. So shoot us any thoughts, questions, leave us a comment, shoot us an email, financialtangent@gmail.com. We've also got, our listeners on Rumble, Spotify. This
Apple Podcast now.
video
right?
will go on YouTube,
Yeah.
and yes, Apple
Wow,
Podcasts.
we're growing.
I'm looking at making us an account on Apple Podcasts as well. So
Excellent.
exciting things to come. So shoot us your thoughts. Anything is much appreciated. Thanks, everybody.
Yeah, thanks everyone.
Thanks, guys.